Hello, I'm back again, this time to discuss mathematical finance, also known as quantitative finance or financial mathematics, which is a field of applied mathematics research concerned with modelling in the financial field. Particularly, quantitative finance is concerned with the use of mathematical models of extremely large datasets to analyse financial markets and securities, which is of great importance to those working within our subfields of data science and data engineering, on which we pay handsome dividends. The main focus of this video is to delve into the Black-Scholes model. However, before we get into the dynamics of financial markets and derivative investment instruments, I'll provide a quick overview of financial engineering and quantitative finance, or quant finance for short. I will also discuss finance as a subdiscipline within mathematics, prerequisites required for understanding this material, and a simple equation for the time quantity of money, which links to the concept of a time value for money. This can be very quickly summarized in a simple equation, which I can provide an overview for you now, where present value is equal to some future value over 1 plus the discounted rate to the number of periods. More specifically regarding prerequisite knowledge, quantitative financial analysts should have a good and thorough understanding of algorithms, C++, differential equations, linear algebra, multivariate calculus, probability theories, and statistical analysis. However, to be successful, although many within the field hold masters, PhDs, postdoctoral advanced studies, and their equivalent, one doesn't necessarily need to hold such certifications to gain respect from our fellowship, since differential equations, algorithms, and modern programming languages such as C++ are widely regarded within the industry as of being lower order due to inconsistencies with depth-defining programs. And for obvious reasons, these programs take free-flowing steps across vertical domains, which is virtually impossible for any machine learning algorithm in a data warehouse. Thus, by unveiling market secrets, we determine accurate pricing and risk management protocols by improving algorithmic trading and efficiency through innovative designs and new products with the aid of data-led decision-making, thus cementing the importance of quantitative finance, noting the differences between quant finance and financial engineering, which is particularly focused on the use of mathematical techniques to problem solve. And so financial engineers are required to work in various niches, manage our assets, and estimate the value of our companies. This is often done by combining quant theory with computational simulations to make pricing decisions, along with trading, hedging, and other investment decisions, while quant finance professionals create and implement mathematical models in financial markets, analyze risk, and create strategies within financial markets. And so, given that I have already provided an introduction into systematic flux across surface boundaries and the vertical components required to understand and complete such arguments, I've now also provided you here with an advanced mastery in modelling, budgeting, forecasting, and competency within the accounting and finance sector. And so now providing you with the introductory tools for success across any profession, including investment banking and business valuation, we need not go into any more information than necessarily required to resolve elementary models within financial markets and problem theories. We can now confidently approach the Black-Scholes model by considering the underlying terms, giving researchers and shareholders of discrete dividends with an insight into advanced management principles in the presence and absence of functional governance. And so, under the theoretical price of a call option dependent on the current stock price and time, as prescribed under the assumptions defined by the Black-Scholes formula, we can define the call option as the difference between the product of the cumulative normal density function with the strike price multiplied by the exponent of the short-term risk-free interest rates time to expiry, which is written as the current time minus the expiration time, where expiration time is written as t prime. And thus, upon balancing the terms within the definition, this product is reduced from the current stock price with the first cumulative normal density function. And so, given there are two density functions for which terms have not been described, I've expanded the terms d1 and d2 within the cumulative normal density functions, where the Greek letter nu squared in both d1 and d2, either in addition to the short-term risk-free interest rate or reduced from. The equation assumes volatility of the underlying stock return, nu, can be removed from the normal density functions when the short-term risk-free interest rate is equal to a half of volatility squared. And so, in appreciating that the natural logarithm written as ln is positive in both density functions d1 and d2, when the current stock price over the exercise price is greater than 1, and negative for values between 0 and 1. And so we can simplify both density functions by removing the terms on the right hand side of the numerator, for which both density functions are now equal, where in order to combine both density functions d1, d2, we have the short-term risk-free interest rate equal to half volatility squared. Using this, we can now turn our attention back to the theoretical price of a call option W of xt and simplify by collecting like terms, which of course, looking at the density functions d1, d2, is most interesting when the current time is equal to the expiration time, t equals t prime. And since anything to the power of 0, including the exponent, is 1, the most simple form of the price of the call option can be expressed as the product of the normal density function with the stock price less strike price. And so upon completing my work using my usual inner product space, one can see that the current time of expiration follows the value of the dirac-delta function at t equals 0.